And now, here we are again. The S&P's at 4719, and your year-end target is what?
4750 to 4800.
That's crazy, Tom. That's crazy. How do we get there from here?
Yes, I know. Anything can happen the next 2 weeks, right?
Joining us at Post 9, Fundstrat Global Advisors co-founder and head of research, Tom Lee. Welcome.
Happy New Year, everybody.
So everybody was negative this time last year, but you were not. Why?
Yes. Well, it's really two things. One, we thought inflation would fall like a rock, whereas many were bracing for a decade of sticky Fed fighting inflation. And the second was, if that was true, that we would avoid a hard landing, and soft landing was the most probable outcome. So that's pretty stock friendly, right? Inflation falls like a rock, you avoid a hard landing, and markets were down 20% the year before.
So in 2024, will inflation keep falling like a rock, and will we still have a soft landing?
Yeah, I think your food chart is spot on. I think consumers will realize that the rate of price increases is slowing. We saw it in the UMich surveys. That will give Fed a lot of leeway to cut rates next year to keep real rates constant. Housing and autos is really 70% of inflation. So both are going to normalize, and that means 2% is going to be very visible next year. And I think it's a huge relief for equity markets when that happens.
Tom, Happy New Year. First
New
off, congratulations on your calls this year. You've been directionally correct. That's hard to do, so kudos to you. You're top dog now, 5,200. You have the high estimate for the S&P 500 for 2024. Johnson Stoltzfus, we just had him on. He also had 5,200. You're top one. I wonder if you can explain what goes into making that up. It's always a little bit of a mystery to us what you macro guys do. You know, an analyst who covers Caterpillar, he studies Caterpillar, earnings estimates and makes a projection, but you have to do this estimate from the top down. So what goes into this? Do you guys get together in a retreat on the weekends and, drink a lot and figure out what's going to, come up with a number? How do you come up with this 5,200?
Yeah, it's really sort of three parts. The first part is, what is probable based on sort of market history, like where we are in the business cycle, what did the markets do the year before, where's positioning. That's more of gives you a pretty wide highway to think about what markets could do. So next year, double digits is more than a 50% probability, even though we were up 25% this year. But then we look at E, the earnings, and we think, can you grow 10%, which I think is easy base case because there's pent-up demand for CapEx, and we know the PMIs are going to turn. And the guidance actually has been pretty decent. And then it's what multiple do you apply? This is where I think people make mistakes. When the 10-year is at between 3 and 4%, 65% of the time the PE is over 18 times. 50% of the time it's over 20. That's since 1900. Well, the S&P equal weight is 15 times forward, or ex-FANG, it's 15 times forward. Well, if that 15 goes to 18 or 15 goes to 20, the stock market's going to be up 30%. So we figure, well, you hold the multiple, earnings grow 10, you get 5,200, but that means there's upside to that number.
Yeah, I think it's been a year where markets have been surprised by not only the resilience of the stock market, but the fact that inflation fell really quickly, and the Fed, which had really held really strongly to a data-dependent view, an inflation war view, I think essentially gave that up yesterday. I mean, I think it's now proven the Fed is now focused more on managing the business cycle.
Okay, so what can you still put your money into from here that has upside? I mean, the commercial real estate arena perhaps is easing off with the long bonds not so problematic. So we saw the KRE, the regional banks, doing a bit better. What areas do you see that have potential?
Well, I think investors in the next 12 months are going to start to say, what things get fixed if the Fed just stops being so aggressive on rates, right? So if rates fall, and it makes a lot of sense that asset quality gets better if rates fall for the banks, commercial real estate comes back, small caps, which are highly levered or higher levered, really benefit. So to me, this, the next 12 months, it seems like small caps can be up 50%. The Russell 2000 just crossed 2,000 today. So
50%.
Yeah, so it could be Russell 2000 hitting 3,000.
I mean, we're seeing it today, to your point. It's another 3%, almost 3% day for the Russell 2000. It's up 8% in a week. It's up 17.5% in a month. How much of this hinges, though, on yields continuing to move lower? And is there a point at which this steep fall in yields actually signals issues for stocks rather than positivities?
Yeah, I guess on that latter part, you're wondering if it turns into a growth scare. I think that people are trying to figure out what message is coming from lower rates. But remember, it was just in October where everyone said term premia is permanently higher, future inflation expectations are higher, the Fed has to keep a higher neutral rate. I think on 3 of those things now, given how much inflation's fallen, I don't think there should be the term premium. It should return to normal. The neutral rate probably is staying lower, and then inflation expectations are coming down. That means the 10-year, could be below 4% for all of next year, and that would be really big for small caps because, on a price-to-book basis, they're trading at where they were in '99 relative to the S&P, and that was the start of a 12-year outperformance cycle.
What if inflation doesn't continue to fall as fast and furious as it has? What if it gets really sticky here?
Well, I think that's the misconceptions. 60% of core CPI is housing and car plus car services. Housing and car services account for 1.74 percentage points of the excess inflation. We're at 1.6% of the excess. So literally those two things account for all of the inflation. Housing just needs to stabilize at 3%, and used cars are going to fall like 30%. So, I think inflation is going to easily hit the 2% core target sometime next year and sort of stay there.
Why shouldn't we worry about Washington? It's an election year coming up in 2024. One of the potentially big spoilers of 23 was Congress not being able to function. Does that pose any danger for the markets?
Yeah, it is a perception question because, gridlock historically is good for equities. In 24, I think people expect Senate to flip and House to flip, so it still remains gridlock. I don't think Washington dysfunction it can be sort of create seismic events, but in 2024, those will probably prove to be by the opportunity.
Of Morgan Stanley Investment Management. Andrew, just to kind of tag on to what Dom was showing us there, it's interesting because the so-called catch-up trade, as we were describing, that 200 basis point differential between the equal weighted and the S&P 500, to me, that's happening largely during a period where you don't have much in the way of fundamental news. It's after a lot of the earnings reports have come out. You've got obviously a lot of reaction to a potential pivot by the Fed. What does that indicate to you as we look into 2024, when we should get some more idiosyncratic information, some earnings reports, some fundamental news? What does that tell you about just kind of the trend and the broadening out that we've seen this year?
Sure. Well, look, first of all, Leslie, I think you have to remember that, unfortunately, the first year off a bear market low, investors sell stocks. It happens all the time. We saw net outflows from equity, mutual funds, and ETFs for a year off the COVID low, and we saw it again this go round. And it's about 1 year later, investors flipped from being bearish to bullish. It happened in February of 2021, and it happened in November of this year. And when they go to buy, when they realize they shouldn't have been selling, they should have been buying, they look around for things that they feel that they could play catch up. So it is entirely logical that the equal weighted S&P has played catch up to the cap weighted because it was really lagging. And so as I move into next year, the breadth of the market, and so what Dom talks about, so many stocks are working now. If you look at history, it is an extraordinarily bullish signal for the market. You have to have your head in the sand to really be bearish at this juncture. It means the market is breaking to the upside. As Contessa said, we're near that 47.96. I think when we break through that level, you're going to see an even higher level bullishness. Keep in mind, the market has gone nowhere for 2 years, and that's about to flip. So I think it's a bullish sign for the markets going into next year. My only comment, I'm always interested in what people do not expect. I hear everyone talking about how equal weighted will outperform the cap weighted. That seems to be an overwhelmingly consensus view next year. And so I'm intrigued by, well, what if these big stocks, they have not kept up, obviously, as Don's pointed out, they have not kept up with the broader market. And so they look like they've stalled out recently. So new money I think new money coming in might want to flip and say, well, maybe these stocks will play catch up. Yes, they've done better year to date, but they've kind of lagged recently.
Interesting. Well, you've got, what is it, $1.4 trillion that went into cash this year. Obviously, cash was an attractive asset. Bonds did pretty well if you're a bond investor. And I know you believed that investors were underweight equities going into Q4. Do you believe they are still underweight equities, especially as you look at the various attractiveness of the other asset classes out there?
Sure. The hottest product this year was the money market. And my experience is whatever is the hottest product usually doesn't do well the next year. So if rates come down because the economy is slowing down, that will make the money market not as attractive as it was this year when rates were higher. Some of that money will come out and it will go into bond funds, and some of it will go into equities. Look, at the end of the day, we've just seen fund flows turn positive on a weekly basis. It doesn't stop after 3 weeks of positive flows. I think that money will come back into equities, and that will push the second year of a rally as it did in 2021. Doesn't mean that the market looks a little bit short-term overbought, but I think it's a good sign for equities for next year.
How much does investor psychology play a role, especially as you kind of turn that calendar year over into the new year? You've got obviously 2023, really the Magnificent Seven kind of catapulted into the consciousness of your average investor. Do you think because the returns were so strong throughout the course of 2023 that could be maybe a hindrance to performance next year, just based on psychology factors alone?
Well, first of all, I love that you bring up psychology, because I think it's incredibly difficult to predict GDP, earnings. Look at all the people who predicted a recession this year. Earnings were going to collapse. Boy, oh boy, was that dead on wrong. But what was so consistent is just what you mentioned, psychology, which is, unfortunately, investors cumulatively get bearish after a bear market. And we came into this year with overwhelmingly negative consensus. And so it's entirely consistent with what we've seen in the past. We are moving slowly from the fear stage to the greed stage. And I don't think 1 year is enough. I think it will continue. That is the consistency of investing. As I said before, I think predicting economic data is very, very difficult. And all you have to look at is what was the average price target for this year to know that that's a fool's game. So yeah. I think the psychology is we are in the process of moving from fear to greed, but we're really only very early in the stages. I think next year is the continuation of 2023.